Hi, in this episode we'll be looking at the financial statement analysis. You are welcome to this channel once again. We'll be looking at the three main financial analysis, which are the current ratio, quick ratio, and debt to equity ratio. The current ratio of analysis checks the current asset of a business and its ability to take care of the current liability. So which means basically we look at current ratio over current liabilities, ratio 1. So if the current asset of a firm is more than the current liabilities of a firm, your answer would be greater than 1, ratio 1. Any answer you get should be put as ratio 1. So the usually acceptable ratio should be something between 1.5 to 1.9 thereabout. There is no fixed acceptable range, but a business that has between 1.5 and 1.9 is said to have some ability to cover the current liabilities from current assets, which is a fair thing. A business which has an answer that is negative, like if your answer is less than 1, if a business answer is less than 1, that business is having insolvency or illiquidity. It's a bankruptcy situation for the business. Many lenders might not even be willing to lend funds to that kind of business. The second ratio is the quick ratio. This tests the quickness of a firm's ability to pay its short-term obligations. So quick assets looks at the liquid assets. Liquid assets are current assets excluding the inventory. Inventory is said to have the least rate of liquidity, so it's not considered as a liquid asset. So current assets minus inventories would give you liquid assets. So liquid assets divided by current liabilities, ratio 1 is the quick ratio. Quick ratio is also called acid test ratio because it tests the quickness of a firm's ability to pay current liabilities. The third financial analysis ratio is debt to equity ratio. That looks at the firm's overall debts. That's long-term liabilities, the loans, the debentures for corporations, the long-term loans, and fixed overdrafts. Fixed-term overdrafts, they are considered debts. So ratio of this to the equity of the business is considered. Usually shareholders and loan debentures or potential loan holders, they look at the proportion of the firm's capital to the third parties. So they look at how much of the capital structure of the business is contained by the owners, the shareholders, or the equity holders versus the portion that is owned to debts. So if the debt to equity ratio is high, meaning if the debt of a business is higher than the equity of a business, it shows that the business is highly geared. And an highly geared business might indicate that the business is not really self-sustaining. And for many other factors that we look at, but main thing we look at is the proportion of capital structure that is owned by the equity and the portion that is owned by the to the third parties, to the outsider, the part that is borrowed. So these are three key analyses for financial interpretation. So if there is any question about this, kindly put your question in the comment. It will be responded to accordingly. Thank you very much and see you in the next episode. Bye.